In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon once again to all of our market rebels. It's another round of Coach's Corner, but it's actually 8:30, 8:40 where I am right now in Stu, because we are again had to record early for a number of reasons, but we will be broadcasting this at 4 p.m. when you'll see us. But so Stu, what are the futures doing right now? Are we still looking a little green or no?
4 p.m. today or 4 p.m. on Thursday?
Oh, excuse me. I'm so sorry. It's 4 p.m. on Thursday. Yes.
Thursday, right. Yeah, we're actually a day earlier. The futures are down a little bit. ADP came out, market just took a little bit of a breather here. Looks like they're down 34 and the tech futures are down 17. No biggie.
Yeah.
Close.
Yeah, that's pretty
Gave
small.
up a little of the earlier gains.
All right, so we'll have to see how it plays out here during the day. But for everybody else, let's get started with Coach's Corner. And as you know, we like to start off with a little thought question here, our Chalk Talk, little roundup with the coaches here in the huddle. The question is, how can you sell calls against 100 shares of stock but have unlimited upside potential? Normally, when you sell calls against shares, that's a covered call, which has limited upside. And one of the questions that we want to explore here is, why would you even care? Why would you still want unlimited upside? So as we always talk about, there's always trade-offs. That is such a key point. You cannot escape it. So for any strategy, even this one right here that we're going to show you, there are trade-offs. There are pros and cons.
Bill, you know what I just thought of? You know why this is such a great question? Because I think it's a great question because it's forcing you to think outside the box.
It is.
You know, you have sell calls, like you said, sell calls, covered call, buy rate, flat line, no more upside. But here we're actually talking about having upside.
Yeah.
So we really want people to just kind of take a step back and say, well, is that possible? And not just here, anywhere.
Exactly.
Anywhere in the options market. There's so much possible to be able to create what it is that you're looking for.
Yeah, we could do an entire course on this. I'm choosing one strategy just to make the point. But if you're kind of wowed by this and going, hey, this is pretty cool, I never thought of it, you haven't seen anything yet, because that's the whole power of options.
Yeah.
So for right now, we want you to just think about this question. How would you go about it? Is it even possible? And then we'll come back to it here a little bit in the presentation. So our topic today is avoid extreme outcomes. So this is a kind of a basic tenet in finance, just a general guideline that you want to avoid the extreme edges, the types of trades where you could make it all or lose it all. So an example that I often give is, let's say, flipping a coin for a lot of money. You're either going to double your money That's extreme. Or you're going to lose it all. That's extreme. Is there a way that we can work somewhere in the middle? And if there's not, you might want to reconsider that trade or at least understand what you're up against. But a lot of times we find that traders just don't. They're taking these short-term, very big bets, and it really comes down to a flip of the coin. And if you happen to get hit with a streak of bad luck, it could be lights out, right? So anyway, let's talk a little bit about these extremes because this can also get a little tricky because there are different definitions. So one definition is we could say that these are really the severe, the high impact outcomes, things that we might call a black swan. So things like 911 or COVID, the financial crisis, 2007, 2008. These are things that nobody, or at least very few people saw coming with 07, 08, that have dramatic impacts. So this is what we're talking about if it's, now of course you generally can't avoid these, but we're talking about intentionally stepping into a trade that could have very high impact outcomes. So for investors, you might say, well, what's the largest expected drop in the S&P 500? Kind of stress test it. Will my portfolio, will I survive? Will my portfolio survive? As a related example, let's say if you're in the credit card industry, what's the largest number of defaults that we could allow and still stay afloat? And don't think that it's not possible to hit those numbers. These are the things that you have to ask. So if these limits are too high, then you could cut off potential growth. All right. So if you say, oh, I don't want to expose myself to this, let's really over hedge it. Well, now you're cutting off the growth. Or let's not invest all of our money because I'm fearful of these potential drops. And if the limits are too low, then what happens? You can
You
get
don't make any,
completely wiped out, right? So again, it's this whole thing. One of the themes of this is going to be about balance. We always want to find good balance. And if there's a simple way to really what this whole presentation is about, that's it. We talk to lots of traders, whether in Q&A, I know you do a lot of one-on-one coaching, and we hear this all the time where their trades are just heavily loaded on something that could be really, really good or really, really bad. And you're going, why are we doing this?
Bill, this reminds me of that dude. I think he was in London, who came to Vegas. Remember that guy? He bet.
We're gonna talk about that.
Oh, are we really?
We
Is that a good
absolutely
idea,
are.
or was that not a good idea?
We're gonna talk about that. We're gonna say that that's actually one of the exceptions. So, sorry, that reset. So we've got a second definition here, and the second definition are really, again, talking about extremes. These are the largest and smallest numbers that could be in a set of something. So let's say if you buy the 100, 105 vertical for 250. All right, we know that's the maximum loss. We know that the most it could be worth is 5 points, which is therefore you could make a maximum of 5 points. And so your maximum gain is 250. Well, we could say that those are extremes, right? If you end up losing 250, did you hit the extreme end of that? Yes, you did. If you made 250, did you hit the extreme end of that? Yes, you did. But are they really devastating? And that's kind of the question we're saying, well, probably not. So for the most part, and I'm going to emphasize most part, I don't know why that's not moving. There we go. These are not things that we have to worry about. This is why we use the options. They give us the ability to limit these potential extremes. But not always. That doesn't mean that we completely ignore them. All right, so not in the short run, not going to be a big deal if we get hit with a 250 loss, but it could definitely be in the long run. And I'll show you why in just a second. So it's not just about the dollars of saying, hey, look, yeah, we didn't, 250 is not a big loss per trade, but we just did 10 in a row. And now that might be, and even though it might not be a life-changing loss, it now might keep you away from an opportunity that you otherwise would have taken. And again, it's always easy to overlook the things that you don't see. And traders don't understand that this is a very real potential cost. We were just talking about this the other day in Q&A. So for a really good example, back with Bear Stearns, right? What was it? The stock was around 65, I think.
Yeah, they
And
bought the 30 puts,
the $30 puts with 7 days to expiration. You
15
looked it up,
cents.
15
15
cents,
cents.
unbelievable.
Yeah.
And I read somewhere that I think it was a $500 investment on Thursday was, ready for this, $30,000 on Monday.
Hmm.
Now, again, that was a really big shot. You're going, what stock has ever fallen from 65 to 30 in a handful of days? But you're going, you know what? We've got subprime. There's been a lot of talk about it. We know that Bear Stearns is highly levered. Maybe this is something I want to take. And yet you now missed it because you blew out 2,500 here, and you're either gun shy to go back into it, or you just don't have the cash readily available. So we have to be careful about saying that this doesn't count, because it does. So to show this, this is the Excel sheet that I was bringing up here.
Bill, you talked about a couple of days on that Bear Stearns. A couple of days, you could really define it any way you want. Talk about a stock currently that we have in play, UNH. That got cut in half. It's the same thing, right? 60 to 30, 65 to 25. That got cut in half. It took a few months, didn't take a couple of days, but it definitely got cut in half.
It,
So, things happen and things happen quickly. And a lot of times it's unexpected. And you wind up saying to yourself, how could that have happened? When you really should have been saying to yourself, this could definitely happen.
this could definitely happen,
Am I going to be okay?
and am I going to be okay? And that's the thing that we find that people just don't do.
Even on that 250 that you were talking about, one trade, $250. All right, no biggie. Well, suppose you're doing 10 lots and it's $2,500. And suppose you get like you're about to do, I've seen this before somewhere.
4 or 5 in a row.
Yeah. Suppose you get 10 in a row, right? All of a sudden you started out with 25 G's in your account. Now you're down to zero.
Now you're down to zero.
Now what, right?
Even though none of the trades were extreme, right?
Now you're done. And now you're missing out on any future opportunity because you got sick of it. And you said, this stinks. The market makers are ripping me off.
Yep.
And now you missed out on an opportunity to do really well down the road, investing or trading or both in the marketplace.
Yeah, exactly. So what this spreadsheet is 256, a series of 256, let's say, coin flips here. And I did this because we can do 16 across and 16 vertical. So, we've got up here, we have, let's see if I can get my pointer. We have, we just started flipping. We have tails, heads, tails, heads, tails, heads. This is all random in Excel, by the way. Now, interestingly, if you were to ask most people to jot down what you think is a random sequence, this is how most people would do it. They tend to alternate too much. They might do 3 in a row, would really be stretching it, maybe 4, but even that, they're going to be a little fearful of doing that if you ask them to create one for 256. But the reality is you should expect 7. And that really catches people by surprise. They just think that would be such an unusual thing. Now,
7 in a row, heads,
7 or tails. Yep, 7 or tails. So what I've done here is this number in red is counting the biggest number. It does allow for wraps. So look at this. We got 12, and there they are. Look at that, 12 in a row. So you have to say, can this happen? Yes, it does. So, just by pure chance. But you can see we got lots of 4s, 3s, 5s, 6s. Now I'm going to hit F9. I was just going to do a screenshot of this and put it in the PowerPoint, but then people think, you just sat there all day until you got the one you wanted and you cherry picked it. They don't realize, look, there's 6 in a row. So that came in, got actually in both of those rows. Got it down here again. So this is also why it's false when people go, man, I just got hit with, let's see, where's our 6? I just got hit with 6 in a row. Let me stop for a while until the market becomes a little more well-behaved, or until I get back in sync. I hear traders say, I'll wait till I'm back in sync. And so you step down here and you find that this is the date you want to get back in. And there you go, you get hit with another 6. And you can see where they start thinking, I'm doing something wrong. They don't understand this is just the nature of randomness. This stuff can happen. Or maybe we decided to start here on this date.
You know, and there, let's see, where's my 6? I'm sorry, there they are. There's 6. So you can see that we do F9 again, 6. We should see 7s most of the time, but there's a 10, 7,
There's a
8,
7.
7. Let's see, there's another double digit.
Hmm.
Doesn't take too long to hit 12s. There's lots of 7s. Doesn't take too long to get 12s and 14s in here. So the point is, you can see that in every single case, we have long streaks. And that's just 256. So if you want to think of those as 256 trades, you are going to have lots of streaks. And unfortunately, what do you think people do? Oh, it's because I'm using my super duper technical indicator and that's what's causing me to win. Or there's 11. Now, normally to get 11 in a row, what would that be? It'd be 1,024 twice, would be what? 2,048. You would need to do 2,048 coin flips to expect 11, and yet here we got it with just 256. So the point to understand is that long streaks, unexpected streaks can happen. And so just because you think that you're limiting the losses and you're saying, okay, well, I'm not really exposing myself to extremes, it is still possible. And especially when you're doing short-term options, you've got to be really careful about how you're sizing those positions. So let's come back into the presentation here. So quick reminder for everyone, marketrebellion.com/get started. We have a whole host of great articles and videos, topics just like this to help you get started with options and to make better decisions. So now, Stu, let's go back to a strategy, one of many, but I chose this one just because it's fairly simple. I think a lot of people are familiar with it. But we hear so many times. We just got somebody yesterday in Q&A who said, oh, I got burned in my covered call.
Yeah.
Burned how? Did the stock go down? No, the stock went up. Well, that's not burned. That's maximum gain.
Yeah, I asked him in Q&A
that's the best you can do, right? How did you get burned?
Is
Well,
that
I
what he
could
said?
have done a lot better.
I was looking for his answer. What was the issue? I couldn't get the answer
I
from him.
don't remember but it was the fact that it had just gone up and through the strike.
It went up. Oh, he got burned, and that's how he got burned?
Missed the opportunity, right? So this is, again, just to show the power of options, because sometimes people think, oh, that's a negative. I hate covered calls. I got burned on it. All right, well, if you think that's true, here are some solutions. So one thing you can do is to sell fewer contracts. Now, of course, this requires you to have more than 100 shares because you can't sell a half a contract. But let's say that you buy 200 shares trading for $100 and you sell one call for 105. I'm sorry, sell a 105 call.
105 strike.
The 105 strike is what I meant to say. I'm sorry. So what happens is that our 200 shares looks like this. Now we have what? Extreme outcomes. You can see we can either make 100% of the gains to the upside, but we lose 100% to the downside. And it's this straight line, dollar for dollar up and dollar for dollar down, that most people would like to avoid. Not avoid in the sense of not being invested, but let's alter it a little bit to fit our needs. So if we sell 2 calls, then what happens? So this is what that trader was talking about. Flattens out. We completely flatten here at the strike. Right, there's our bend. But again, think about it. These are extremes. You're either going to make dollar for dollar up and get 100% of the gains, or you're going to get 0% beyond this. So again, you're still kind of putting yourself into these extreme outcomes, and that's why a lot of people feel burned or that they don't like the strategy, even though this is still the maximum gain. Now,
even though that's what they signed up for?
If that's what they signed up for at the beginning, right?
If the very best thing happens, this is what's going to happen. Oh, but if it does happen, I'm going to get burned. What?
I'm going to get burned. Now, also, a little psychology here. This is why it's important to understand your strategies. Let's say the stock was 100 when they put this on with this strike at 105. And what a lot of people say is, what a beautiful strategy. I'm getting paid to sell the stock at an advantageous price. You're not. Now, if the stock were 100 and you got assigned and collected 105, That would be a very cool trick. And yes, you did get me to set an advantageous price. But Stu, what's the only time you're going to get assigned here by selling the 5 strike? Is
Well,
if the
let's put
stock
it this
is,
way. It's not going to be an advantageous price. How's
it's not
that?
going to be an advantage. It's going to be because the stock is 106 or
Higher
110
than
or 120.
105. Right.
Right. You're not getting paid to sell at an advantageous price. You're getting paid to sell at a disadvantageous price. That does not make it a bad strategy. But as Stu said, that's what you signed up for. And if you don't see it in the way, then you're going to feel burned. All right. So that's why this idea of completely capping it catches people off guard. Now, again, there's trade-offs. We can see that the black line, if we held the shares, there's our break even right there at 100, but we get shifted to the left by the amount of the premium. So depending on how much we collected here, we're going to reduce our cost basis by that. That's the main reason for doing the covered call, is for this. It's a very small one, or at least depending, but relative to the volatility, it's a relatively small downside hedge. That's the primary reason for doing it.
Yeah.
It
It's
is
just a
not
level of dollars that you sold that if you need to, which means if the stock
Right.
goes the wrong way, you can apply towards the loss that you take on
That's
the
right.
stock.
Yeah, if the stock had fallen to this level right here, say roughly at 97, and I had the shares, I'd be down 3%.
I would not say that this strategy, this covered call buy rate thing, is an income producing strategy.
I was just going to say that, right? Don't do it because you're going to generate income. You are stepping into a liability. That doesn't make it bad, but that's very different from generating income.
You may wind up making money.
You might. You might.
But that is really different from what you actually have, which is, like Bill just said, it's your liability that you have to contend with. And
Yeah,
there's an opportunity, the potential opportunity cost if the stock really takes off.
Yep.
So
we've talked about that, where income is revenues minus expenses, and that's not what's happening here.
No.
It's you're adding a liability to it. And again, I'm not saying it's bad. I've done them many times. I'm just saying that you have to understand what you're getting into.
We all use them. We all use that premium in different ways. Yep.
But now what could we do if we don't like these extremes? Again, either saying I want 100% of the gains in these beyond this region, this crossover point, or 0%. Again, that's why most people feel burned. Well, if we have 200 shares, nobody says you have to sell 2 calls. That would just be the maximum. Well, why don't we work somewhere in between? Why don't we sell 1 call and do this? See, now what I've done is I've lifted this this flat line here, and I've shifted it higher. Now, I haven't shifted it as high as if I sold no calls, and I can see that the green line still sits a little to the left of the black. I have still a smaller downside hedge. It's not as far to the left as the red, but I do have unlimited upside.
But now I'm not going to have as much money coming in.
And that exactly, that's the same thing as saying that the downside's not as big.
Yeah.
Yep. So they're just trade-offs. I'm not even going to say that this is better. I'm saying that if you're the person that's going to feel burned because this thing really took off, well, then don't flatten here. Don't do the covered call just because you go, hey, I can generate $6 by pressing send. Yeah. There's a reason the market's paying you $6 for that.
And you can also adjust these numbers.
Sure you can.
So if you're going to sell one, let's say the 105 call is trading at do you have a number here where it's trading at?
No. I don't. We could figure it out, but
it doesn't matter. So let's say the 105 call is trading at $2. So now you have $2 of downside. So now you only sell one. So instead of taking in 400, if you did 2 of them, now you take in 200 because you only sold one.
Yeah.
So now you're a little annoyed because you're kind of missing your 200.
That's right. So
here's an idea, right? Just maybe go to the 103s or the 102.5s and sell one, pick up a little more dollars.
Pick up more dollars.
Pick up a little more dollars, keep your upside, and have the liability a little closer. Again, it's just a trade-off. It's not better. It's not worse. It's not anything. It's just a trade-off of you trying to, create the picture that you'd like to see happen.
Yeah. Now let's revisit a topic we've talked about before, a crossover point, which is where these strategies all produce the same profit or loss, which is every comparison has to have at least one. So we've got one where they all meet right there. Now look to the right of that, and you'll see that the black line performs the best. It sits the highest. Green is second, and red is third. But if you look to the left of the crossover point, they flip. See, now black is the worst, green is still in the middle, and red is the best. But notice that the red and black are always at the extremes. And the green is in the middle, always. The green in that case, if we go 1, 2, 3, or 1, 2, 3, the green is always number 2. It is always right there in the middle. Not going to be your favorite, but also not going to be your worst. And it's this whole idea of capturing some type of a blend. And that's so important for using options. So let's look at another example. And before
let me just reiterate something to this. There's not a better.
Never.
People are constantly searching for the magic ticket, which one's better.
Right.
It's just not there. Stop looking for it. It doesn't exist.
Right. Compare your strategies. You'll see that it always has a crossover point. If you think that a vertical spread is better than a long call, graph them both and there'll be a crossover point. If you think the butterfly is better than a condor, graph them and you'll see that there is always at least one crossover point.
Yeah,
That's
add a stock giveaway. Yeah.
And it's a dead giveaway that you cannot say that one is better, because again, you'll see that one side, in this case, the black is the best, and on the other side of the crossover point, it's the worst.
Just like you can, you can't say this strategy is better than this one. Options are better than stock. Stock is better than options. Futures are better than options.
Nope.
A pairs trade is better than not a pairs trade. None of that exists.
Right.
None of that exists.
And that's a great point. People have got to get that out of their heads, because we hear that all the time in Q&A. Which one's the best? So now let's take a look at another course of action you could take. And before we do, a quick reminder, marketrebellion.com/get started. So in that first example, I assume that we had 200 shares and that we sold one call instead of 2. Well, what if you don't have more than 100 shares? Well, now what are we going to do? Well, options are very versatile. One thing we could do is to sell a vertical spread. So rather than selling calls, consider selling vertical spreads. Notice the key word there. You're still selling. You're still generating cash in to reduce your downside.
Notice you didn't say generating income.
I did not say generating income. But it is going to create that credit so that we can reduce our downside.
And keep in mind that vertical spread in our world here is a zero net contract trade. Right? You're not long contracts. You're not short contracts.
That's the magic.
So you're not adjusting any of the contract net
on the wings. Correct.
On the wings, yeah.
Yep. So let's say you've got 100 shares and you sell one 105 110 vertical spread. Now the strikes don't really matter. You could do the 100 105, but you're just selling a vertical spread. And of course that's going to generate a credit. And if we do that, what do you suppose our risk graph looks like? Instead of being completely flat on the right like we saw with the covered call.
You're gonna have your upside wing still, because you still have the net long one contract, or it's actually stock at this point. In this example, right? You didn't change the net overall to zero like you have on the buy right? You just selling one, buying one. So you have that little flat line in the middle. That's where the vertical spread is. And then after that maxes out to whatever the width is. In this case, $5. Bang, that's done, and you get to continue on making money if the stock takes off.
Right. So we have 0 deltas in here. That's why that line is flat. And notice that it's between these 2 goalposts right there, which are the strikes. So we will just create a kind of a dead zone only between the strikes. But if the stock is below there, we own the stock free and clear. Both options expired worthless. But if the stock is above here, this is where people get thrown and they say, how do I still have my 100 deltas? Because as Stu said, you don't have any deltas on the vertical spread on the wings. So for example, here's our short vertical spread. We've got delta 0 here. That just means that line is flat. All right, so that's always going to be delta zero. No matter what happens to the stock's price, you're not gaining or losing any additional money. But notice between here, what have we got? See how that line leans to the left? It looks like a short stock position. So that's delta -1. So think about it. You have -1 deltas where? Only between 105 and 110. Remember that. -1 deltas or -100 only between 105 and 110.
Right. And
If we
think outside the box, everyone. You're short 105 call. All right. That's going to be delivered to you as short, synthetically, you say you short 100 shares. And then at 110, you get to pick up 100 shares. That's the one you're long, right? You have the right to buy. So they
That's
net
fun.
out to zero,
That's
right?
right.
And in between, you're short 100. This is
That's
at
right.
expiration, of course.
Exactly. And then the vertical spread's done. So when we go back to our graph, so think about this. Here's our long shares of stock, which should be pretty easy to understand that we're delta 1. And if we get outside of the vertical spread, we're delta 1.
Mhm.
So why are we flat in here? Because we still have 100 deltas from our stock, but as Stu said, we have minus 100 from our short spread. So +1 -1, or plus 100 deltas minus 100 deltas, is flat. And so that's what's causing that little landing strip right there. So yeah, now it's not saying that you're going to lose. The stock is, let's say, 105, and it's somewhere between 105 and 110. Let's say at 107. Yeah, you're in here, you got this gain. It's going to act just like a covered call between 110 right there. But in case the
105.
stock really takes off, you got these nice deltas up here.
And that's what that guy was talking about yesterday. He always gets burned, right?
Always gets burned, right? So now what's the trade-off here? Well, yeah, you might have sold the calls for $3 by themselves, but you might get 2 for the vertical spread. So you're not going to, why? Because we're still going to sell, let's say, the 105 call. We get the same price for that, but we have to shell out some of it to buy the 110, and therefore we're receiving fewer dollars.
And yeah, that's right. If you sell the spread at 2, you keep this in mind, everyone. If you sell the spread at 2 and the stock really takes off and that spread goes to 5, you lost 3 on the spread.
On the spread.
But look what you're getting on the end there, on the other side. You're getting that upside forever.
That's right.
Right. That's the trade-off.
It's a trade-off. And so
if the stock goes down, you get to keep the $2.
Yeah. We got a little bit of a downside hedge. So there's another way to do a little twist on a covered call, or the idea of trying to receive some cash to give us a downside hedge, but not feel like we got burned. Why? We're avoiding the extremes.
Yeah,
we're not saying I want to have 100% of the upside or 0%. Now, what else can we do? If vertical spreads, you just talked about thinking outside the box. If vertical spreads have 0 deltas on the wings, whether you're long or short, they have 0 deltas outside of the strikes. What would happen if we sold 2 vertical spreads? Is that going to put us in a short position to where we start losing money out here?
It doesn't change the net contract.
It doesn't change that. It only changes it between the strikes. So let's take a look at that. You buy 100 shares, you sell 2 105, 110 spreads. In the previous example, we sold 1. Now, again, your broker's platform might make it look the same, but what's happening is that your numbers have all doubled out here. So even though this line doesn't look like it's changed, it's now minus 200 deltas. But we have delta 0 through here like we did before, but now we're delta -2 or minus 200 between the strikes. So remember that. We are minus 200 between 105 and 110. We've got minus 200 deltas. So now check out the math. Now the gray was the one that we just saw, and we kind of ghosted out there. And look what we did now. Now we've created negative deltas through here, a little dip, and then we can still continue on with our 100 deltas, but we got a bigger downside hedge. The black line sits to the left of the gray. And in exchange, we have to allow, now not for losses, you can see that we're still above 0 on this point. The stock closes at 110. We're still in gains. It's just that we would have had more had it closed at 105. But if it goes on beyond there, look at that. So this could be good for maybe some really volatile stocks where you don't want to completely cap the upside, but you don't want to completely leave the downside open. So here's our 100 deltas. And why is that leaning down now? See, when we had the gray one, it was flat. Why are we going this way? Well, again, think of your deltas. What is the stock delta between 105 and 110? Always delta 1. How many deltas do we have between here? -2. So if you're +1 and -2, what are you on a net basis? -1. You are short 100 shares only between 105 and 110. But you're starting that short position from this gain. So you're still in winning territory. So now you can see the trade-offs by selling 2 vertical spreads. If the stock falls, we have a bigger downside hedge. We're going to outperform the gray line. The green line sits higher. But the trade-off is on this side, we will underperform compared to having just sold 1 spread. Now here's where things get really, really cool with options. What else could we do, Stu? We could take the credit that we receive from this and maybe buy a put.
I knew you were going to say that.
What if we did that? What if we did that and we just kept walking this risk graph all the way up? Just kept walking up with it like that.
But here's the problem, Bill. Let's say I pay, let's say I do this a couple times and I take in $500 from doing this spread thing. And then I buy this put. I take some of that money and I buy this put and I spend $200 on this put. And the put goes to 0.
Yep.
And now I've lost 100% on that put.
That's correct.
Aren't I going to get annoyed that I now I'm just being stupid here. I mean, people.
But we hear this every single day.
We hear this all the time.
Oh, I lost 100% on this put. That's unacceptable. No, you didn't.
This is a big picture kind of a thing, right?
Yeah.
This is a strategy that you're working and you're working and you're working and you're creating these hedges and you're helping yourself if things don't go right, and you're gaining access to the upside so you don't get completely burned. And yeah, you give a little back of the money that you made in between those 2 strikes there from the short delta. But the other side of that is you get to participate all the way up, should it go all the way up.
Yeah, you've still got this. So the thing is, you can see that the way that I've drawn this here, now you wouldn't be able to do this from the get-go because that would be an arbitrage. But over time, you can see the way that I've drawn this, here's 0, that the entire graph is sitting above 0. So think about that if you're in some, especially before NVIDIA split, you've got really high volatility, you've got a very big position to protect. Now we can work between the extremes. I can get some kind of a downside hedge, still a pretty good one. I can still have unlimited gains. But then if I want, I can take some of those gains and buy this put and make sure that I don't fall below a certain level. And over time, I can shift that curve higher and higher and higher, always now hoping that we get some big explosive move up here. And if not, we're still okay.
Now, remember, in this strategy, you are bullish. You are, exactly. And you are remaining bullish. So even though you're buying that put for a hedge, right? You actually, this is going to sound a little weird maybe to some people, but you actually want that put to go to 0. Yeah. You don't want to have to call your agent and say, I'd like to cash in my insurance policy.
My auto insurance policy, right. Right. Yeah. You're hoping that your auto insurance expires worthless. That shouldn't be a surprise to you.
Yeah.
That's what you're saying. If I do have to cash it in, it's because something really bad happened. And
That's right.
Kind of easing the pain, maybe not even making you whole, but it's just not putting you into an extreme outcome where you now have a devastating loss. Right. So anyway, it's just again to show the many ways that we look at options. And one of the things I wanted to show here too, if you've been listening to Coach's Corner, you'll see that an underlying theme is always about this. How can we work into the middle here, between the extremes, and instead of predicting the market, just make sure we're okay. But if you listen to most people talk, the conversations go like this. Hey, Stu, what do you think Microsoft's going to do next week?
Yeah, I think it's going to go up, Bill.
Okay, well, let's go out and buy some calls. Let me buy this one for $3 is too much. Here's one for 75 cents. That looks good. I've now minimized my risk, and now I'm an options trader. No, you're a guesser. You're throwing darts.
And you just created a like very small probability of a
Very
win.
small probability of any success. So the point is, why don't we take a different approach and say, how can we construct our portfolios, our risk graphs, so that we can still live to play another day? We're never going to get wiped out because we're not exposing ourselves to extremes. We're just playing in the middle. And so regardless of your definition of extreme, whether you're talking about 911 or coronavirus, or just the fact that you've bottomed out, you've hit the smallest or the largest number in a set of numbers. There are different definitions of extremes, but we really want to try to avoid both of them. All right. Now, are there exceptions, Stu? There's always exceptions.
Always an
Always an
exception.
exception. We usually don't like to use the word always, but we will use it there. There is always an exception. Now, Stu had mentioned about roulette, and I thought about that as well when I was putting this together. So very quick example. Game of roulette offers lots of different types of bets. You can bet on a single number, two adjacent numbers, three, called a street bet, corner bet. There's all kinds of bets, and they have different payoffs. So let's say that we take this one at the top, 35 to 1. We're just going to bet on a single number.
Mm-hmm.
Well, that might sound like a good deal, but if we look at the fair value, you're going to win $36. I was looking at that if we covered the board there, it would cost us 38. We would lose 5.3% of our money. So even if you cover the board, all 38 spaces, right? So you spent $38, you're guaranteed to win, you're going to get your dollar back, you've got 36 back, you're still down $2. So this is a really good way to show that there is an absolute edge in the house's favor. Because here you created a guaranteed winning bet, and yet you've still lost. So not only is this extreme, it's really a bet you have to say, why would you want to take it? But we know that people do. So if you do roulette, this is kind of what your risk graph will look like. If you're going to beat roulette, now this is for 3,000 spins of the wheel at a single number, you can see that you can win in the short run. Obviously, if we did the simulation lots and lots of times, we would get different paths. But one thing they would share in common is that the far right will always be underwater.
And that's because of the 5.3.
Because of the house edge. So if you're faced with a bet like this, such as let's say going to Vegas, now we don't want to work in the middle. We want to bet bold because we have a house edge against us.
Because that's the best chance of you. Every time you play it again, you are now stepping into the trap of, well, you're gaining more access to this downside.
That's exactly right.
Giving the house more of you, so to speak.
More time. Again, you can beat it in the short run. So if you're going to step into like a casino game or something that you know has a house edge or an edge against you, playing conservatively is not the answer. That will unless you say, well, it's just going to be fun that we can sit there all night, maybe a different story. But financially speaking, that's not the way to go.
Yeah, this is not entertainment.
What you want, exactly. We're just talking about how would you maximize your chances to make money. Here you'd want to bet bold. Now, you mentioned there was a guy, his name was Ashley Revell, and I took a screenshot of you can find this on YouTube, just look at that name right there. But check this out, Stu. He sold everything he owned, traveled to Las Vegas, and betted on one spin of a wheel for $136,000. Now, if you read the story, he was a professional gambler. So why would he do something this crazy to bet on one spin? It's not crazy. It's extreme, but he knew for sure if he took $136,000 and said, let me sit there for 2 weeks, Vegas would fly him out there for free. They'd give him a free room because they know for sure they're going to take 5% of that money. The longer he sits there, the bigger that's going to become. He will eventually go completely broke. But if you do it on a single spin, he now has 18 out of 38 chance, just a little bit less than a coin flip, of doubling his money. And in the world of betting, that's not a bad deal. But what we do know is that if you sit there all night long, it's a horrifically bad one. So again, this is one of these cases where you can say, Am I choosing to do some type of a game, let's just call it, where I have a known expected edge against me? If that's true, bold play is more optimal. But we don't have that in the stock market. What do we have at our back, Stu? We have,
Time.
we have a nice tailwind. We have an upward drift. We have time. So, no, we don't need to bet bold. And yet we see so many people taking very large positions, betting bold. They get burned and they go, well, how do I repair it? And this is why they say, oh, gee, options are risky. Options were designed to hedge risk. They are insurance policies. But because of the leverage, yes, you can abuse them. There's no doubt. But that doesn't mean that's how they have to be used. So the thing that we want people to think of is that
where's my repair button? Can you show me?
Exactly. We get people that ask us, how do I repair this? You don't. You just don't. So the thing to remember is that success, and it's not just in finance, it's in everything. It's always achieved through balance. And the best way to balance is to avoid the extremes. All right.
Nice.
Everything involves a balance. If you think back when you were in college, you might say, oh, I want to do the best that I can. Well, therefore, if that's true, you should never sleep. You should just study. Well, how's that going to work out for you? Right? It's not. You have to say, all right, I can't always be studying. I also need some downtime. I need some mental breaks. If you're an athlete, I want to get the biggest and strongest that I can. Well, now you're risking injuries or risking becoming maybe too big and too heavy now to where it's costing you on the speed side. It's always about a balance. And you have to say, what are you trying to balance? And once you've answered that question, you'll find that options will always have a solution. But the one thing that we want to do is to tell you to avoid the extremes. So back to Chalk Talk, everyone. How can you sell calls against 100 shares of stock but have unlimited upside potential? Now, we've limited it to 100 shares, so we can't do our selling half the number of contracts. What do we do here?
Vertical spread.
Sell a vertical spread. There's an easy solution. Again, not the only one, but it is one. And if it's one that you didn't come up with, then we'd like to invite you to join us here at Market Rebellion. Maybe just join us for Q&A or some one-on-one coaching with Stu or Scotty and say, I need to understand more about this because this is not how I'm approaching my options trading. So I hope that gives you some things to think about. Hopefully we're going to have a good couple of days here when this actually airs on Thursday. But Stu, any closing comments?
Think outside the box, everyone. Think about, always try and figure out what it is that you're trying to do. Don't go for the hype. Don't go for do this one because this one's best, or
right. Avoid the hype.
This one's going to make you a millionaire in 10 days.
Yep.
Don't go for any of it.
Don't want it. No, I don't care.
Try and understand the product. That's going to be your edge. Your edge is to understand the product and how to fit the product into what it is that you're trying to do. That means you have to have a goal. That means you have to understand what the product does, what the outcomes could be on different in different environments, up days, down days, up years, down years, different volatility levels. Understand the product. That is going to really help you design what it is that you're trying to do when you come up with whatever it is that you're trying to do.
Absolutely. And just as Stu said, remember, it's so important to have a goal. It's one of the key things that we teach in our Q&As because you can't even define risk unless you have it constrained by a goal. So think about that one for a little bit, and we will see you next week on Coach's Corner. Have a great week.